So this is a quick fundamental analysis on Intel Corporation. I want to focus specifically on the Foundry segment because from what I'm seeing, that is what is driving the company down. So I want to start first with CapEx and their investment plan since the IDM 2.0 strategy that started, I think it was like in 2021, early 2021. You can see it on these charts. I mean, you can see this represents CapEx to revenue, all right? And back in 2021, it was 0.2, so only 20% of the revenue generated in a quarter was dedicated to capital expenditures. That value was as high as 60% in Q1 2023, and now it's stabilizing around 0.4, approximately 40%. That's a lot. So 40% of the revenue that the company generates is being burned. I mean, it's not technically burned, it is invested in the Foundry, but I just don't see enough traction in the Foundry segment to justify such a high capital expenditure. Why? I'm going to go straight to the point. If we have a look at management's expectations for the 18A, here it is. This is from the last earnings call. Well, it turns out that the company, they won't get to peak volumes on 80A, on the new 18A until probably the beginning of the next decade. That's 5 years from now. So the question is, are you patient enough to see the company burning CapEx? Yes, the guidance is going down. The CapEx burn, I think it's 18 billion. You will see it in a moment because I'm going to go through all the slides. It's about 18 billion in 2025. It's an improvement from last year, yes, but 18 billion, it's a lot when the company, is going to see upside in 5 to 6 years. So I don't know. To me, this doesn't make much sense. Let's go back to the capex to revenue guidance ratio, because I have here Taiwan Semiconductors. So this is also a Foundry. You know them; they're the number one in the world. Just look at the trend. I mean, I'm gonna have to hide my profile. Do you see what I mean by this? It's crazy how efficient Taiwan Semiconductor is in the current AI supercycle. So their investment in CapEx when compared to revenue have declined significantly. So it was up to 0.6 in 2023, in Q1 23, and now it's just 30%. So half of what was a couple of years ago. Not bad at all, if you ask me. And this is one of the reasons why I'm not keen, and I just don't see the upside in Foundry. Now, if we look at the trend in capital expenditures to see the actual value, not just the ratio, in the past quarter, you can see the trend is improving. Sorry, I'm just going to show you this. Instead of going through the numbers, I think it's better to look at the visual. So yes, over the past 3-4 quarters, it has been decreasing. So this is great news. However, if you look at cash flows, lever free cash flow is still negative. And in fact, the CEO, let me just have a quick look where it was. He said that the free cash flow, I believe it was here, the last full fiscal year of positive adjusted free cash flow was 2021. And yeah, to him, this is unacceptable. I think this was the CEO, Li Butan. Let me just see. Yeah, that was the CEO in the prepared remarks of the last earnings call. And yeah, to improve that, he's naming different he's naming different strategies like driving operating leverage and managing the capital outlays. In plain English, this means layoffs. That's the operating leverage. And the second one, managing the capital outlays, it means cutting down on the freaking CapEx, which is burning the company. And also it's having an impact on shareholders because, well, the higher the CapEx, the less you can distribute to your shareholders, either as dividends or as buybacks. So if you have a look at the plans that the company has for Foundry, let me refresh the page. It's been a while since I opened that. So this was from 2022. And you can see there the plans that the company has in the Foundry segment. So Intel wants to invest, that was back in 2022, about 100 billion in the US to expand the chip making capacity and capabilities in Arizona, New Mexico, Oregon, and Ohio. So the one in Ohio, Intel wants to invest about 28 billion to construct 2 new leading-edge chip factories in New Albany. So out of those 28 billion, Intel will receive about 7.86 billion from the US CHIPS Act. I talked in my previous video about this development and why the US probably, most likely, is going to use the US CHIPS Act or part of it, because 85% of it is already binding. So maybe the remaining 15% is going to be used for the investment. Something to look for. I recommend you to watch my previous video on Intel, because that's going to give you some idea on what I think about that. But I don't know, like these 4 sites, it's a lot of capital investiture. And on the positive side, they stopped the foundry in Poland and Germany in the past quarter. I don't think I highlighted that in my in the materials I have, but yeah, that was a positive development. So it's slightly less cash burn because now those 2 foundries are stopped. Now, coming back to operating cash flows. So if we exclude the CapEx burn and we look at operating cash flows, the picture is not bad. So 2 billion in the past quarter. Yes, maybe front loading had to do with this because you had more customers advancing purchases in anticipation of the fear for tariffs. Maybe, I'm not really sure. I don't know how many people truly believed that tariffs are going to be that bad. Even tariff on semiconductors, 100%. Yeah, that's a high figure. The question is, how many US-based companies are actually negatively impacted by this 100% tariff on semiconductors? So something to take into account. The trend, I mean, it's awful if you look in the long term. Back in Q4 22, we're talking about 7.7 billion in operating cash flow, and now it's just 2. So not the best, but on this regard is fine. However, if we take into account the different non-charges and impairments, the thing is quite bad, to say the least. If you have a look at net income, which, by the way, takes into account all these non-cash expenses, well, the trend is quite raw. In the past 6 quarters, the company had negative net income. So we're talking about Q4 23 was the last quarter with positive net income. And in the past quarter, the main drag was from an 800 million charge. I believe I have it here, 800 million of impairment charges and 200 million in one-time period costs. Of course, this was a hot topic during the Q&A, and some of the analysts asked about the breakdown of those 800 million in impairments, and it seems that it had to do, part of it, with a higher net book value than the value that the company could get in the open marketplace if they sold certain tools within that foundry segment right now. So the company wrote them down to that value, so they will be held in assets held for sale. So they didn't sell them, but they lowered their expected value because they know they're not worth as much as they initially thought. Again, this is a headwind, and it's contributing to the negative picture in the bottom line of the company. So, speaking of the negative picture, we have a recent report in Tom's Hardware. Intel is now only outselling AMD by 2-1 compared to 9-1 just a few years ago. So we have this published as of the 14th of August. It's quite recent. And if you look at the trends in this report, it's insane. So if you look at the CPU markets, this is the x86 architecture. Intel is relatively stable. You cannot see here a major concern. However, and this is key, if you go to the desktop CPU, you can see here the market share, and things look quite raw for Intel, particularly in the last quarter in Q2, where you can see a significant decline in market share, and AMD, it's relentless. And the same trend is seen for notebook CPUs. For notebook, no, for server CPUs. These are the important ones because, of course, they're used in data centers. So, yeah, you can see the trend since 2020 approximately, where AMD has been gaining quite a significant amount of share. And you can see here probably the main reason, or one of the main reasons why Intel has seen such a decline in revenues when compared to the highs in 2020, 2021. So I think that was the main charts. Now, if we look at the estimates that Wall Street has for the company, they look quite bad in the near term. So if you look, these are quarterly estimations. Yeah. So for the next quarter, the expectation is for a decline about 1.3% in revenue. For the fourth quarter of 2025, the expectation is actually negative 6% year over year. And you can see that the street only expects a slight improvement in the second half of 2026, possibly due to the ramp of the Panther Lake, which is the next generation of mobile processors. Currently, the Lunar Lake is not very good, and the main reason is because of the power efficiency. Other players can, especially ARM, have better performance or equal performance for lower power usage, and of course, this is depressing the market share that Intel has in the mobile processor space. So overall, I'm not really keen on the outlook, I have to say. Capital expenditures, this is what I mentioned earlier in the video, about 18 billion for 2025. That's the expectation. And this is what I mentioned earlier, where Germany and Poland are not going to go through in the investment of the company. Overall, you can see it in the street's expectations, end maybe the second half of next year, or maybe the end of next year, is when Intel is going to take off in terms of revenue growth. Until then, I really don't see enough upside. And that's why for now I prefer to stay on the sidelines. As I said earlier in the video where the government was looking to take a position in Intel, which will be interesting, we have seen similar waves of excitement. Back in February, when Taiwan Semiconductors was rumored to take a position, or to actually even buy part of the Intel's Foundry segment. You can see back then the share price went up by about 40%, just to come down a couple of weeks later. Is this going to be the same? I believe the answer is maybe. And you have to be open-minded here, because if Intel strikes an interesting deal with the US administration, and the US administration gets, let's say, something similar to what happened with MP Materials, where they had a stake of about 400 million in the company. If the US government has a majority stake in Intel, I believe sentiment could turn around, because that would be a huge bet that the government is taking into the company. Now, if everything we see, if all we see in the upcoming weeks are a couple of press releases saying that, we're planning to buy, or maybe we're trying to push our local or domestic semiconductor companies like, AMD or Nvidia to use Intel's Foundry, I wouldn't be very bullish on that. So I really need to see the government taking a position over $1 billion at the very least, at the very, very least. So that could change sentiment. Whether it's probable or not, I think it's not very likely. That's why I prefer to stay on the sidelines and see what happens. That said, from a price perspective, if shares break the 30 level, you can see it here. You can call me crazy. I mean, here you can see consolidation around this price, and I think it's a psychological support. In this case, it will be a resistance if it's testing this again. If I see shares in the low to mid 30s, I may reconsider my rating and maybe I will buy some shares. But until then, I'd rather stay on the sidelines. Anyways, thank you for watching, and I hope to see you in the next one.